We are waiting a few more minutes for people to join in, and we will start pretty soon.
Hello, good evening.
So hello again. This is Cedric Rimaud from the Climate Bonds Initiative speaking. It's my pleasure to welcome you to this webinar about the results of a study we have conducted over the last few months with Astris Finance and the TCX Fund. So it's my pleasure to introduce Hugo Virag and Javier Osegueda from Astris Finance, who have been authoring a study on modeling the FX hedging for renewable energy projects. And we will have also Professor Farhad Tagizadeh-Hesary from Tokai University. But I would like to let Christian Hübner from the CAS Foundation say a few words. The CAS Foundation has been supporting this work, and we have been able to do this study thanks to their help. So please, Christian, if you want to say a few words.
Thank you, Cedric, for the kind introduction, and as well a warm welcome to everybody, especially to our speaker today, to this ASEAN webinar series. On behalf of the Regional Project Energy Security and Climate Change in Asia Pacific of the Konrad-Adenauer Foundation, I think that the topic of which we are discussing here currently is very, very important, especially when I look around to the climate political landscape around the world and the recent changes we could observe in the last weeks. We're facing more and more carbon neutrality pledges, and I think that really demands more to do on climate finance and having better renewable energy finance at all. So I'll leave it with this and give it back to Cedric and wish a very, very interesting discussion. Thank you.
Thank you very much, Christian. This work really started when last year we did research on how to unlock more capital towards green projects, in particular in Indonesia. And we found out that there were a few components that were responsible for allowing green bonds to be issued in the market. One of them was credit enhancement, but the most important one was also FX hedging. And as a reason, thinking that it was worth to explore the components of FX hedging, and together with the TCX Fund, we have prepared this body of work that is, being shown today through the results of the study that Astris Finance has been performing. So we had a webinar a few weeks back to present the hypothesis of this work, but today it's all about the result of this work, and I will let the mic to Hugo Virag and Javier Osegueda to present what they've done in 6 markets here in Asia and explain how they have modeled the FX hedging of hypothetical transaction backed by power purchase agreements. So Queen, I will ask you to show the slides of the study, and Hugo and Javier, the floor is yours. You're on mute, Hugo.
Yes. Do you see the share screen?
Yes, we can see.
Okay.
Can you hear me?
Yes, we can hear you now.
Okay, sorry. Thank you very much, Cedric, and Christian, for your kind words. Pleased to be back again for this episode 2 of this, in the context of very interesting study we have been working on together with TCX and Climate Bond Initiatives. Good morning, good afternoon, everyone. So my name is Hugo Virag. I'm the head of Astris Finance for Asia Pacific. Just maybe a quick word of introduction. I'm here together with my colleague Javier, based in Ho Chi Minh. Astris Finance is a financial advisor in the infrastructure and energy sectors. We are headquarters in Washington, DC. We have a global coverage, including 3 offices in Singapore, in Southeast Asia, Singapore, Saigon, and the Philippines. We do a lot of work in connection with arranging financing in the renewable energy sectors. It accounts for 50% of our activities globally, both in developed and developing markets, in particular Latin America, Asia, and increasingly in Africa. We like to be at the forefront of the development of new financing solutions, in particular in illiquid or liquidity constrained markets. And for instance, recently we have arranged the first project finance for wind and solar project in a number of markets like Argentina, El Salvador, and Vietnam, among others. So very pleased to be with you, and without further delay, I think we should kickstart and present to you the initial outcome of this study. Should we? Do you mind turning to the maybe yet table of content? That would be great. Let me put that. Yes. So just that's what we're going to cover in the next, I guess, 20 minutes or so. We give you a bit of context about the purpose of this study and the objective. Then we'll take you through the methodology we have followed in order to conduct this study, and then we get into the core of the presentation, which is presenting the initial outcome of the study. Next slide, please. So the context of the study, as Cedric reminded us in the introductions, that we see in Southeast Asia or in Asia more broadly a trend and direction towards de-dollarization of the power purchase agreement, in particular in the renewable energy sector, and the trend is in particular obvious in the less developed markets, which are the subject of this study, and naming Myanmar, Sri Lanka, Nepal, Vietnam, and Indonesia. Local currency PPAs creates a cross-currency risk for developers of renewable energy projects. As we all understand, that the risk is related to the mismatch of revenues. The project receives revenues in local currency from the purchaser of the electricity, whereas those projects are typically funded in hard currency, in particular for the international developers who are developing those projects in local markets. So developers, when it comes to financing local currency PPA, comes with 3 questions. First, can I achieve the similar type of returns in dollars when I develop a project with a local currency PPA? Is there sufficient, or are there sources of capital to finance this local currency PPA, either debt, bond, or others? And ultimately, the third point is how can I cover the cross-currency risk, and how can I mitigate the risk? Either available products to do so, or financing solutions. So that's really where we're coming from, trying to see how we can mitigate this cross-currency issue that developers are facing. Typically, there is two ways to mitigate that cross-currency risk. Either you look at, avoiding the mismatch of currency and raising, your financing in local currency against your revenues in local currency. It gives you a natural hedge. Or you're looking at, raising dollar financing was associated to a hedging product that enables you again to enables the project and the developers/investors to hedge the cross-currency risk. And there are a number of cross-currency products typically available in markets, either onshore, offshore, and that varies market to market. Though in the context of this study, the local currency financing structure to fund local currency PPA will need to address these developers' issue in every of these markets. And in all of these five markets, the developers, or when we look at arranging these the relevant financing structure, we're facing liquidity issues. Either there is no or very limited onshore local currency capacity to fund those projects. And by local onshore capacity, I really refer to long-term domestic funding on a project finance basis. So really on the funding on the back of the project cash flows that developers are used to have in more developed market. Another possible liquidity issue is the availability of a cross-currency hedging solutions to enable to raise the offshore financing in dollars.
Hugo, I want to ask Professor Farhad, because he has got quite an extensive experience in energy policies and projects in the region. And Professor Farhad, in terms of the financing structures that we see in Southeast Asia, what would you say is the most typical way that projects are being financed, and does that follow what Hugo is explaining?
Okay. Thank you very much, Cedric. So it's a pleasure to be here today. And so it's my pleasure to join this project, although I joined in the later stage, but it's very interesting. So regarding the financing scheme and the capital structure, so what we are seeing in Asia is that because majority of the financial system in Asian economies is dominated by banks. So bank financing is the major source of financing. However, when we are talking about a renewable project and like other infrastructural projects, bank loans might not be very suitable because bank resources are coming from deposits. And deposits are mainly short to medium term, for example, 1 year, 2 years, 3 years, or maximum 5 years. However, these projects that we are discussing, these are long-term projects. So it will be maturity mismatch if allocating short to medium term resources for long-term project. So in especially in Southeast Asia, and I'm in all these countries that we are discussing now, including Nepal and so on. What is lacking is the involvement of institutional investors. For example, pension funds and insurance companies in financing these types of projects. So most recently in some of these countries, they are developing pension funds. For example, Vietnam most recently started pension funds, and also because many of the Asian countries, they are aging, so they need to have a developed pension system. But the issue is that although they are developing pension funds, for example, in Vietnam, but they are using their resources for investing in other countries' markets. For example, the Vietnamese pension funds, they are buying US government bond instead of circulating their resources domestically, and instead of allocating these resources for their domestic infrastructural project or other renewable projects. So this is an issue that needs to be solved. Yeah.
Thank you very much. Sorry, Hugo, back to your presentation, please.
No, it's very relevant because it's a good transition, but with what I was going to go to, just as to the main objective is, as Professor Farhad said, indeed, these mismatch between the sources of capital and the needs in terms of tenor is typically what most of these markets are facing with their that explains the limited resource or the no resource capacity of domestic banks to finance long-term renewable energy project, meaning that we need to turn, or developers need to turn again to international financiers offshore that have that practice and experience and longer tenor capacity and figure out how to bring these long-term dollar financing into those developing markets. And in the context of a local currency PPA, the only way to do it is indeed to have the appropriate cross-currency hedging solutions in order to cover the mismatch between the revenues, the currency of the revenues, and the currency of the debt. So this is the purpose of the main objective of that study is indeed to test how such a product, I mean, an onshore dollar financing swapped into a local currency to avoid mismatch, is relevant to finance local currency PPA, and that's, yeah. I think then we can move on to see how we try to address that point. Should we go to? Can we move to the next? So here in this discussion, in this presentation, when we refer to local currency financing solution that we are testing and assessing in terms of feasibility, we really refer to these what we call here the synthetic loan structure, and a bit in a slide or in a few minutes I will let Jerome from TCX to explain a bit in more details how that kind of structure works. But as local currency financing here means really that that structure, dollar hedge and swapped into local currency. Very quickly, so the 4 steps we've been following for this study are the following one. Step one, first one, is in every of these 5 markets, we've been looking at a relevant pilot project in the renewable energy sectors, where they're typically that will be typically in a way funded by a local currency PPA. Understanding for each of these markets how that the tariff structure of that PPA work, whether it's a flat local currency denominated PPA, whether it's some form of indexation possible, or some form of hybrid, tariff structure, mixed dollar, local currency. Second step is we look at understanding all the bankability parameter of the markets, in particular of interest when it comes to structuring for each of these pilot projects, the relevant capital structure, and I will come to that capital structure in the next slide. So we're looking at liquidity matters in terms of access to dollar reserves, in terms of availability of project financing, in terms of eventually regulatory constraints, is there any cap on the maximum interest rate that can be charged or charged to a projects, like there is one in Myanmar. Then we'll, step 3 is for each of these pilot projects, we have built a proprietary financial model to test for respect to each of the market and each of these pilot projects, the attractiveness of the local currency PPA, and by attractiveness, by reference to the returns the developers could receive in dollars. Again, as I said initially, developers tend to assess that activities by reference to the dollar returns they could receive should there be a PPA in dollars, or if there is already one in that given market by reference to the dollar PPA in that market. So that's the approach we're taking to assess the LC, local currency via PPA. And then we obviously in that context price the LC local currency financing options, both offshore, onshore, and the bond component. You will see that in the capital structure that we're using for us or this project, we have assumed a bond in dollar tranche. So yeah, moving to the next slide. So this is basically in a nutshell, representing the pipeline of projects we have been working on for each market. So that's the step 1 of the analysis.
Maybe Hugo, it's a good time to ask Jerome if he can come in and maybe comment on why those markets are relevant for the region.
Sure.
Jerome, are you able to tell us why this market makes sense from the point of view of looking at the attractiveness?
Yes, good morning, good afternoon, everyone. So if we consider the genesis of that study, is the following. So the Climate Bond Fund Initiative and TCX, I think the best way to understand where we fit into the equation, Cedric, is on the capital structure. So we, as you know, Cedric, we've been talking and dealing with project developers for years now. These developers, when it comes to local currency PPAs, were always naturally trying to hedge the asset and liability structure of these projects, because they would receive a stream of local currency receivables derived from the tariffs they negotiate with the off-taker in these 5 countries. But we could never quite know whether the cost of financing they would raise, whether, as Farhad mentioned, whether it's from the local banks or offshore, was conducive to business. So the modest attempt of that study is to provide some answers, which is what Hugo is revealing. So we picked these 5 countries because in all these markets, TCX provide long-term hedging solutions. So if you look at the duration of PPAs ranging from 20 years to 30 years in some countries, we can hedge foreign exchange risk for all these tenors and even beyond 30 years. So to the extent project developers can attract funding for 30 years in Indonesia, and the financier willing to take credit risk on that project for 30 years can hedge with TCX. On the capital structure, you can add that long-term 30 years local currency debt block. The same way that if the green bond market would allow a local bank or project developer to issue for 30 years, you could achieve the same result. So the product exists. Investors' appetite does exist as well. So now the question is, when you put the credit spread of the lender with the cost of hedging together, so the project developer can secure long-term financing in local currency, does it make financial sense? And that's the question that Astris was asked to answer.
And I guess we've seen in ASEAN some long-dated green bonds being issued. For example, AC Energy in the Philippines has issued even a perpetual green bond. So it demonstrates that there is capital available for financing long-dated projects, like Professor Farhad was saying. And Professor, may I turn back to you again on these 6 markets? Do you see some differences? I guess Indonesia already has a little bit of a local corporate bond market existing. Vietnam, Myanmar, Sri Lanka, and Nepal don't have much, but do you see some differences between those countries, or would you say that they are fairly similar?
Yeah. So thank you, Cedric, for your question. So yeah, the countries are in the different development stages, and also their financial system is also in the different development stage. For example, when talking about the advancement of the financial system, Indonesia has better situation, and countries like, for example, Myanmar are in the earlier stage. But generally speaking, similarity of all of them is that the share of bank is larger when comparing to non-banking sector, and their financial system is dominating by banks. So it means a solution that is working, for example, in Vietnam, probably it's also, workable in Indonesia as well. And another thing is that all of these countries, majority of the Asian countries, including these countries in this study, they are, in their governments and their central bank, there is eagerness to encourage the expansion of the bond issuance and shifting from, and reducing the reliance from short-term bank loans in order to avoid, for example, the economic catastrophe that happened in Asian financial crisis, which was mainly coming from the banking sector, for shifting more to the bond. So what I see in all these countries, this interest is existing among all of these governments. And when comparing, these countries' credit risk and the credit rating, comparing to many other regions, for example, comparing to Latin America. So these countries, these regions, they have a better credit rating situation, and because of a stronger economic underpinning and low political risk, which is existing in most of this country. So it means, there is a transition from, banking to non-banking, but with different speeds. For some of them, it is faster. For some of them, it will take more time.
And yet their energy policy is also looking towards renewable energy as a way to develop their energy sources. We've seen it in Myanmar, for example, with a big tender recently, and Vietnam has been pretty strong on the solar energy as well. Would you say that this is the way forward for these countries?
Yes, what I see is that almost all of them, they have, all of them are emerging economies, developing economies. They have a huge energy demand, and they are, net importer of, fossil fuels. So it means that their countries, their government, they have planned for developing domestic energy resources. First of all, in order to improve the energy security, because they want to rely more on domestic resources, and secondly, to be in line with the environmental goals, with the Paris Agreement and SDGs. And this is the reason that what we have seen, as you have mentioned, in Myanmar or in Indonesia and also in Vietnam, mostly recently in their government strategies, there is more interest toward green development and green energies.
Thank you very much. So back to you, Hugo, if we can maybe move to the study itself.
Yes, absolutely. So let's go. Just one comment on this slide. I think the common denominator in a way between most of this market, except maybe Sri Lanka, is that there is a level of flexibility in the PPA tariff structure that enables to eventually have an hybrid dual currency PPA, part of it being in local currency, part of it to be indexed to dollars. Sri Lanka has a particularity as it has a strong, stringent regulatory framework that prevent US denominated.
So you mean that the PPA is partially paid in dollars and partially in local currency, or you mean it's paid in local, with reference to dollar, but in local currency?
It's in general paid in, so there's two things. I mean that it's in general paid in local currency, though part of that tariff, the revenues can be indexed to dollars. Sorry. Did you get me? Yeah.
Yes.
So you take an example, for instance, for Vietnam in the rooftop solar sectors, the PPA is for the PPA, the revenues that are corresponding to the electricity sold to the user of the rooftop solar farm, it has to be denominated and paid in dong. Though for the electricity sold to the grid, it's paid in dong, though it has to be indexed to dollars. We can move to the next slide. Just mention that because it helps to, in connection with the capital structure that we are now going to discuss. So yes, very quickly, this slide obviously introduced that the base case capital structure that we are testing by reference to what we discussed before, and this is indicated as, you know, the second row, LCY structure number 1. The base case capital structure is structure as typical project finance type of loans or financing, sorry, meaning minimum equity of 30% and a debt leverage of 70%. The debt leverage here is mainly comprised of, for the larger part, the synthetic local currency loan that I will let Jerome explain a bit further in the next slide, and potential and a bond for about 20% of the cost of the projects. So in some markets, we looked also at mixing the capital structure with a local currency debt, so an onshore financing in local currency, when it helps to improve, I would say, the total cost of the financing.
Just one question to Professor Farhad, just to confirm, as in the current state of the market, most projects are financed through case number 1, right, which is equity financing plus a loan in the country or a loan in dollars from overseas. Is that correct?
Yes, currently, I mean, bank loan is the major source of funding, yeah.
So case number 2 and case number 2 this would be hypothetical ways of structuring projects, right, Hugo?
Well,
yeah.
Yeah, I mean, case number 2 is you're referring to our base cases. This is, yes, what we try to, we are testing is how to a local financing, long-term local financing solution could eventually substitute a dollar financing solution, which is the case 1. Noting now in some markets, like Myanmar, there is no capacity for offshore dollar financing on a long-term basis. But case 1 is our benchmark case, because in order to assess the feasibility of the local currency solution, we looked at the returns of the developers that is offered by these using this local currency solution, and compare that with a dollar financing solution, which is the benchmark case. And just one more comment. We have a local currency structure number 2, where basically we do the same exercise, though we assume there that the local currency, the PPA, the local currency PPA could be indexed to inflations, not to dollar, but to inflation. So enables to the project to mitigate for macroeconomic risk and see whether that improve the feasibility of the local currency financing solution.
And most PPAs today in Southeast Asia are usually not indexed to inflation. Is that correct?
Correct, yes.
Okay.
Or is something to be negotiated on a project by project basis. Maybe move to the next slides. And that's maybe the one that Jerome should comment on. This is the.
Yes, sorry, I'm back. Yes, I think what's important to understand when you focus on that pictogram is we enable offshore lenders. Most of them are development finance institutions or commercial investors. So we have swap lines, if you like, with 1,000+ different entities. Not that all of them, Hugo, will be interested to finance energy projects in frontier markets, but we have specialized entities looking at the asset class, whether they are fund managers or development finance institutions. And I think to avoid going too much into the detail, what's important to realize is we, through our swap product, we enable these offshore lenders that have really no interest to take the FX risk to procure a long-term local currency loan to the project company in local currency, and we take care of the hedging. So we absorb the FX risk. And that's the reason why these offshore lenders can talk to project companies, and although they sit offshore, they can provide Myanmar Chat, Nepalese rupee, Indonesian rupiah financing, dong, etc. I think that's probably the best way to describe that pictogram.
Great. So should we move to the next slide? Okay. So this is that's the slide that summarizes the outcome of the study, country by country. There's lots of information in there, but maybe I can take quickly each of these countries and summarize the outcome, taking more specific question if need be. So bottom line, starting with Vietnam. For Vietnam, the outcome is that the local currency financing solution that Jerome just described in a way is value accretive for the investor, meaning that it enables to it enables for the developers to improve its returns or reach a level of returns that is improved thanks to the leveraging of the project with the financing solutions. So here in the example pilot project we have tested, the project has a return of 11.70%, and via the leverage and the synthetic loan solution, you're able to improve the returns to 13% level, creating value for the developer itself. It should be noted that in order to achieve that result, the leverage here is a bit lower than the base case, 60% rather than 70%, meaning that the equity contribution of the developer needs to be higher than typically done in project financing structure.
So Hugo, you're saying that in Vietnam, if a local project owner wants to finance their project, instead of going to local banks to finance it, if they go to offshore lender or investor, and they use TCX fund to hedge the currency risk, they achieve a better equity return, right?
Yes, the solution creates value for them because they have a better equity return. It provides a long-term solution, by contrast with what local banks can do in Vietnam, with some exception, but typically it's less than 10 years. And third advantage is these TCX solution fix the interest rate for the project. So the project is not exposed to the volatility of the interest rate by contrast or by difference with local bank currency, local bank solution where the interest rate is floating over the year of the loans. So those are the three main takeaways, yes.
And Jerome, do you have a comment on the Vietnam case? Have you seen more business out of Vietnam or more potential for business from offshore lenders that want to hedge the currency risk or vice versa? Jerome? Okay, we lost Jerome. So maybe you can go to the Indonesia case.
Okay. So then last thing on Vietnam, I think what shows also the study is that the second local currency case where we assume an indexation to the tariff enables to indeed improve the returns of the developers to mid-teen level and enable also to bring back the leverage to the 70% level. So it's obviously a capacity to index the revenues to local index CPIs or domestic indexation depends on negotiations with the off-takers. So Indonesia, I think what Indonesia shows is that in order for the local currency financing solution to really to create value, the revenues, the PPA revenues needs to be indexed to domestic inflation, so that indeed, as you see in that situation, the equity returns of the developer are above the project returns by about 200 bips, which is not the case where in the scenario where you have a flat tariff in local currency, where in that scenario the local financing solutions is create very minimum value for the project.
In terms of the maturity, comparing Vietnam and Indonesia, the maturity that you assumed is more or less the same, right?
Same, yes. Okay. Now, in order to improve this local currency financing solution, we need to work on the total, the aggregate cost of debt. So, and if we manage to reduce that cost, blended cost of debt by roughly 2%, 200 basis points, we can make these indeed base case local currency solution without indexation workable. So, so again, that will need, that's a way an angle to work further, and it's obviously also very much project specific. All of these simulation, I need to emphasize that, are project specific. When obviously finding project, we are richer in terms of productions and in terms of delivering higher returns, facilitate also to make the local the LCY financing solution affordable and doable.
And the difference in inflation assumption or the depreciation of the currency comparing Vietnam and Indonesia in your model, how different is that?
Maybe I turn to my colleague Javier to respond to that question. Javier?
Can you repeat the question, please?
In terms of the depreciation expectation on Vietnam versus Indonesia, what's the difference that may explain the difference in results?
For the depreciation,
so it depends on basically on the depreciation depends mainly in terms of the evaluation of the inflation and how the inflation into the country. So for Vietnam, we have and assumptions. So it's really in terms of the macroeconomic environment of the country, Vietnam versus Indonesia. And looking at the data, I think Vietnam has a slightly higher, the project are more, slightly more exposed to depreciation compared to Indonesia.
Okay, let's move to Nepal now.
Yes.
Correct.
So Nepal, the outcome of the studies that the LCI the local currency financing solution in the base case will need to be workable, need to have a cost of debt reduced by about 200 basis points. Though if the indexation of the tariff again on inflation is as currently is possible, makes the local currency solution workable and create value for the project. It happens that in Nepal, the PPA structure is very specific, allows this indexation of the tariff to inflation, which means that it helps to make, it contributes to make the local financing solution workable.
Okay.
So moving to Sri Lanka. Sri Lanka is a bit the same scenario as Nepal. There's an element of, in order to make the local financing solution workable, inflation indexation helps definitively and create value for the developers. Without indexation, the LCY financing costs need to be improved a little bit, obviously depending on the expected return, but will be in the range of reduction of the cost of 1.5 to 2%. And we can go in further details as to that.
Okay, and finally, Myanmar.
Myanmar is the most difficult market, no doubt, because the macroeconomic environment and more generally, I think the liquidity constraint, which leads to having a local currency cost of debt, which is very high, is the highest among all these markets. We are at about 20% of local financing cost, meaning that it makes the market difficult without having a discussion with the authorities to improve the level of the local currency. The level of the tariff in local currency, which is in our current assumptions too low in order to make the local currency solutions really workable. But Myanmar is also a market, most of the markets is the greener in a way in the renewable energy space, and there's it's a market where the regulatory environment is the most flexible. So there is room for discussions with the authorities.
And you're saying that the indexation of the inflation tariff is not a solution in Myanmar. It doesn't make the model work.
No, it doesn't. If you look at the figures there, you have a project IR with indexations at 16%, and you have an equity IR which is lower, meaning that the leverage, the debt leverage in local currency, doesn't help to create value for the developers.
Okay, I want to check again if Jerome can hear us and maybe comment on those results, whether there was anything that surprised him. Jerome, can you hear us?
Yes, sorry. Believe it or not, I couldn't unmute myself.
Okay, can hear you now.
Yeah, I could press that button. Look, I think that was part of the experiment, Cedric, is quite frankly, naturally, we do know where we quote. So what is the risk premium for hedging FX risk in these markets? We had a very good idea as to where lenders would charge credit risk. So, and as you know, the all-in cost of fund in local currency is a function of the credit spread that the lender needs to return plus the cost of hedging. But it wasn't our field of expertise at all to understand how generous a PPA in these countries are. So in the case of Myanmar, I still believe that 20% local currency debt for 12, 15 years is actually competitive if you consider that local banks charge on an unsecured basis 14.5 for 1 or 2 years, because this is where the banking sector operates in Myanmar. So 20 to get a tenor extension of 10 years seems actually quite reasonable. I think in the case of Myanmar, what the story tells is, yes, you could tell that the cost of financing is too expensive. That's the way to look at it on the right-hand side of your balance sheet. But I think on the left-hand side of the balance sheet, what it tells you as well is the tariffs paid by the utility is also probably too tight to unlock value. So there is always truth between a PPA that is not paying as much as it should to get the developers in, and in some cases, cost of debt that's too high to make the return, the equity return attractive for the project developer. And what we're trying to do in that study is naturally to reconcile the interest of all parties. Local governments, they want to have a resilient PPA where they pay the fair price for energy. Developers, they want to make a return that covers for the risk. Investors, they want a return that's decent enough for the risk they take on the project. And naturally, we TCX, we bear the FX risk for so long. So we need to make sure we can price where we see it coming.
Yeah. I think that's really the takeaway of this study, and that's the final remark and in the last slide. As Jerome put it, make it the local currency financing solution workable is really a function of three parameters: the tariff structure of the PPA, the cost of the debt, and the expected returns of the developers. So again, for any given project, and again, these outcome could vary quite a bit depending of the sector, the technology, the project. So on a project by project approach basis, the exercise is really to strike the right balance and accommodate the interest and expectation of each of these three main stakeholders: the electricity purchasers, either public or private, the financiers, and the developers. So this study shows that in some markets it works, and in other markets it may work. Should we manage to move the expectation one of several of the stakeholders to enable to strike the right balance.
And I guess in this study, obviously, we have been making some simplifying assumptions because, in an Excel spreadsheet, there's only so much you can model. But it's fairly close to the reality of the projects on the ground. And maybe it's time to ask Professor Farhad again, maybe if you have any comments on the results of the study, first of all, but also what are the areas where you think it would be interesting to look into and the work you are doing for the second part of this study as well?
Yeah, thank you very much, Cedric. Yes, indeed, as mentioned by Hugo and Jerome, I think this study is providing lots of valuable results, which are, practical results, not only for investors, but also for the governments in each of these countries in order to help them to set right policies for promoting their green sector. For example, what presented by colleagues that in Vietnam, even when considering the cost of hedging, the offshore financing would have higher return comparing to domestic financing. So it means that this is from the point of view of investor is good, but from the point of view of government is not good, because governments need to circulate domestic saving and they need to reduce the reliance on the on the offshore financing or foreign financing. So it means why this is the situation. So it means you as a government of Vietnam, if you want to increase the reliance on domestic saving for financing these projects, you need to establish enough de-risking instruments domestically in order to reduce the, cost of capital and in order to reduce the interest rate. For example, tools such as establishment of domestic credit guarantee system, green credit guarantee, that in one of my recent studies we proposed this. So this can help these countries. So yeah, I think it's valuable. And regarding the the next step of what we are doing. So as presented today, this study, in the next study, we are focusing more on the government side. And in order to propose that what is the best policy for PPA. So best PPA means a PPA that minimize the risk and fiscal burden on the government, and at the same time maximize the foreign and domestic investment into renewable projects. So this is our objective in the next step research that we are doing now. So in the next research, so we are modeling this issue and we are working on a new type of PPA that we named it a spillover indexed PPA. So the spillover index PPA, the function is almost similar to the bonds in local currencies, but with floating rates. So their mechanism is almost similar. So the spillover index PPA would be interesting for the governments in these countries and also in other countries, in Southeast Asian countries and so on, as it won't create a fiscal burden for them. And also it would be interesting for the investors as these PPAs will generate a higher return when comparing to local currency indexed to inflation. And so let me briefly talk about this, and then we will have a detailed presentation in our next seminar. So establishing renewable projects like any other infrastructural project will create a spillover effect on a region. For example, consider a region that this region was unelectrified. Then we establish a project, a solar project, a wind project, any type of renewable projects. Then by generating electricity, a spillover effect of electricity will come to this region that will create more businesses in that region. The economic output of that region will increase. That we call it a spillover effect. And then the governments, thanks to this spillover effects, they can collect more taxes from that region. For example, income tax, different types of business taxes, property taxes, because prices will increase. And what we are proposing in a form of a spillover tax, a spillover PPA, is that a part of this tax increase could be allocated and could be used for financing these PPAs. So it means this scheme is providing a situation for the governments that they are not relying on the central government's money, and they are more relying on the spillover tax. And a portion of this tax, for example, if it's 100, 50% could be allocated and 50% could be paid to the government. And governments can set a cap and floor for the, tariffs according to this system that we are now modeling it, and we will present it later.
Very interesting. But in terms of indexing a PPA to inflation, what is the problem with the current, for governments? You're saying it adds to the fiscal burden of the same time. If inflation rises, prices in the country also rise, so there would be more collection from tax purposes. Isn't that the case?
So yes, but again, it means it is a fiscal burden. It means governments needs to pay from their budget. So what we are proposing is a solution which is financially sustainable, and it is not relying on government's budget, but it is relying on the impact of these projects and the taxes that these projects can generate for the government, not from the taxes that governments are collecting from other sectors. So, so because of that, we think this is very interesting. And a spillover tax, it is not a new idea. It's not a new idea, but a spillover PPA, it's a new idea. And it is the first time that we are modeling it.
Okay, thank you very much. I don't know if there's any other comment from Hugo or Jerome, but otherwise, Jerome, do you want to say anything else?
No, I think not. For us, the objective is to re-engage with the developers, get their feedback, because naturally we worked on simplified yet accurate assumptions, but we had to make a judgment call on using how would I say, a common denominator for all these countries. So when developers approach these markets, we expect results to slightly deviate. So I think for us, Cedric, what's really at stake now is to re-engage with the investment community, get their feedback, get an understanding as to whether they see these numbers are close to what they would get when they work on the financial feasibility, and then ultimately provide the right products so they can finance these projects, and ultimately we can all contribute to the production of green assets in these countries.
Okay, thank you very much. So we have reached the end of the time allocated to us. I don't see any particular question from the audience. So I'm going to thank everyone who has worked on this very much, because for Climate Bonds Initiative, it's a way of better understanding what are the parameters that would really foster a more active green bond market in the ASEAN region. So thank you, Hugo and Javier, for doing this work, and thank you for Jerome for participating in this study as well. So the next webinar that we will be hosting on the 7th of December at 4 p.m. Singapore and Hong Kong time will be focusing on the work that Professor Farhad has started to mention about looking more on the policy, energy policy, and the fiscal impact for governments as well. And we will have the pleasure to have additional speakers joining us on the panel. So thank you very much to all of you for joining today. And if you have any questions, please send an email and engage. We can put you in touch with any of the speakers today. And we hope that this discussion can continue. Thank you very much for your time today. Have a good rest of the week.
Thank you.
Thank you.
Thank you.
Very much. Goodbye.
Bye-bye.
Thank you.